Everyone talks about the energy transition, but it's really hitting home now. It's this huge, immediate infrastructure challenge. And it's not just about building more power plants. It's how do you actually electrify everything, keep the lights on reliably. That's where the real action is, right? The grid itself.
That is absolutely the crucial point. And today we're going to dive deep into GE Vernova's latest results, their Q3 for 2025. We've got their reports, their announcements. We're really trying to unpack how this major player sitting across power, wind, and electrification is deploying its capital, spending its money to capture this infrastructure, bro.
Okay, let's unpack this and maybe start with those huge top-line numbers.
All
because, wow, GEV reported, $14.6 billion in total orders?
$14.6 billion, yeah. And that's up 55% organically compared to last year.
Yeah.
55%.
It's just massive growth.
It really is. It's like you can almost hear the utilities scrambling, realizing they need to upgrade like yesterday. Overall revenue grew too, about 10% organically. But the CEO's comment really nailed it. He said the era of increased electricity investment has just started. These numbers basically scream, okay, planning's over, time to build.
Right. And speaking of building and execution, the really big headline was GEV moving to buy out its joint venture partner in Prolec GE. Fully acquire it. That's let's see, $5.275 billion deal. So for anyone not following the specific JV, what does Prolec GE actually do, and why spend over $5 billion right now to bring it all in-house?
Yeah, what's fascinating here is this JV's been around for like 30 years. Prolec GE, they're a top-tier supplier of grid equipment. Specifically, they make transformers, those big boxes that manage voltage levels on the grid. And crucially, they're big in North America, utilities, industrial customers, and data centers too, which are just exploding.
Okay, so GEV is locking down the supply chain for its key market. But let's talk about that price. $5.275 billion. That sounds like, what, maybe 9 times the extra EBITDA they expect next year? Is that a big premium just to get around old contract limits in North America, or does the math really work here?
That's a really good question. Look, there's definitely a strategic premium baked in, no doubt. But it seems driven by this urgent need for capacity and control. Financially, they're funding it roughly 50-50, half debt, half cash they already have. The immediate payoff they're projecting is an extra $2.6 billion in adjusted EBITDA in 2026 on a full-year basis.
Okay, that's a decent bump.
It is. But it's more than just the immediate profit boost. They're also expecting cost synergies, maybe $60 to $120 million a year by 2028. And the real aha moment, like you said, is strategic. North America is their biggest playground. This deal gets rid of old contractual handcuffs they had selling Prolec gear there. Plus, they get direct control over 3 key U.S. transformer plants, North Carolina, Wisconsin, Louisiana. They can ramp up capacity, implement their lean manufacturing, basically attack the grid bottleneck directly.
That makes sense. And it leads us right into the different business segments. Because looking at the numbers, the electrification business just seems to be on fire. Orders there surged 102% organically.
Doubled,
Okay.
102%. It's just,
Yeah.
it's staggering. It really shows you the grid itself is the pinch point for this whole transition. Revenue in that segment was up 32% organically. And that was driven by huge demand for grid solutions stuff, switchgear, the transformers we just talked about, and also power conversion and storage. That's what the battery solution said. Big demand there too.
And there was that specific example, right? The $1.6 billion order from Saudi Arabia for synchronous condensers. Okay, maybe for listeners like me who aren't grid engineers, what exactly is a synchronous condenser, and why is Saudi Arabia buying so many?
Good question. So basically a synchronous condenser, think of it like a giant spinning shock absorber for the power grid. As you add more renewables, like huge solar farms, which Saudi Arabia is doing, the grid can lose stability, its inertia. These machines provide that inertia, manage something called reactive power. They help keep the lights from flickering or going out, spending $1.6 billion on them. That signals a serious commitment to grid quality, not just adding more generation.
Got it. So critical gear for a modernizing grid, and naturally the financials look great because of that demand. Segment EBITDA margin jumped 550 basis points, up to nearly 16%.
Exactly. And you can see their confidence in the updated guidance. They actually raised the outlook for electrification's revenue growth for 2025, now trending towards 25% growth, up from maybe 20% before. And they nudged up the bottom end of the margin forecast too, to 14%, 15%. They clearly don't see this demand slowing down anytime soon.
Okay, so electrification is soaring, but the whole system still needs that steady, reliable power, right? Let's switch gears to the more traditional power segment. How did that look in Q3?
Yeah, power is still the bedrock, really. Orders there were up a strong 50% organically, mostly from the gas power side. And a key detail is what they sold. They booked orders for 20 heavy-duty gas turbines. Importantly, 13 of those were their HA units.
The HA unit, why is that specific model significant?
Well, the HA is their top-of-the-line, most efficient gas turbine. Selling 13 of those suggests utilities are really focused on fuel efficiency and lower emissions, even as they add capacity.
Okay.
It's the best available gas tech for bridging the transition. And beyond the firm orders, which were about 1 gigawatt, they also locked in 12 gigawatts of something called slot reservation agreements.
Slot reservation agreements. Okay, what exactly does that mean? Is that like a guaranteed parking spot for a turbine?
Yeah, kind of. Think of it like putting down a deposit to hold your place in the manufacturing line years out. It's not a final sale yet, but it guarantees the utility can get that turbine when they need it later. It shows utilities are planning way ahead for stable power and are willing to commit capital now just to secure future production. Their total backlog, plus these reservations for gas turbines, actually grew from 55 gigawatts to 62 gigawatts just in this quarter. That's future work locked in.
Okay, that makes sense. Now, the last piece, the wind segment, this has been the turnaround story we've been watching. Still looks challenged sometimes, but showing real improvement underneath, right?
Definitely. You really have to look past the headline revenue number for wind. It was down 9% organically, but that's almost entirely because of a comparison issue. Last year, in Q3 2024, they had a big $0.5 billion gain from a canceled offshore wind project settlement. Take that out, and the picture looks very different. It's not an operational drop.
Okay. But the profitability, that's the amazing part. The margin improved by, over 1,000 basis points on 1,070. How do you do that when revenue is complicated?
That's the real win for the wind team. That massive improvement in the segment EBITDA loss. It shows they're finally making that strategic shift stick, prioritizing profitable projects over just chasing volume. They did it by being much more selective, cutting losses, especially in some older, complex onshore wind contracts. They're basically saying, we'd rather sell less if it means we actually make money on what we sell.
Right, that intense focus, and that lets them adjust their expectations accordingly.
Exactly. So they tightened up the expected loss for wind for the full year 2025, now looking at around $400 million loss, which is toward the better end of what they previously thought. And yeah, they adjusted the revenue outlook down a bit, now expecting high single-digit decline, but that just reflects the strategy, quality over quantity.
So this strong performance, especially in power and electrification, it's generating the cash to fund everything else. They reaffirmed the overall 2025 outlook, right? Revenue heading towards the top end of $36–37 billion.
That's right, and free cash flow guidance held firm too, at $3.0 to $3.5 billion for the year.
Which connects to the bigger picture. That cash flow allows them to stick to their big investment plans.
Absolutely. They're staying disciplined on their long-term commitments.
Yeah.
That's $4 billion in capital spending and $5 billion in R&D planned through 2028. So building factories, developing new tech, upgrading software, it's all happening, funded by current operations.
And they're giving cash back to shareholders, too. Committed to returning at least a third of cash generation. They bought back, $2.2 billion in stock already this year through September?
$2.2 billion.
Yeah.
And at the same time, they're actively pruning and shaping the portfolio. It's pretty smart. They announced selling off their Prophecy manufacturing software business for $0.6 billion. But then they turned around and bought Altea SaaS, a smaller company, specifically to boost their AI and grid software capabilities for their GridOS platform.
So selling non-core, buying tech that fits the future grid makes sense. They also sold off a small stake in a Chinese company and are selling a transmission facility.
Right. Sold about 3% of China XD Electric for around $4.1 billion and inked a deal to sell the Linden VFT transmission facility. It really looks like they're shedding assets that aren't central to making power equipment or providing the software and services around it and reinvesting that cash strategically.
And even tightening the belt internally, right? G&A costs down.
Yeah, adjusted G&A down 5% year over year. And that's not just random cuts. They approved a whole new restructuring plan back in July, specifically targeting G&A. Costs maybe $275 million to implement, but aimed at long-term efficiency.
Which shows they're focused on scaling profitably, not just growing big, but growing lean, even with these massive orders pouring in.
Exactly. Put it all together. The market demand, especially for the grid stuff, is fueling these big moves like Prolec GE, while they invest in future tech and keep a tight rein on costs.
So wrapping up, it really feels like GE Vernova's quarter showed explosive growth where the grid needs it most, electrification, boosted by the Prolec deal, steady performance from power, and a real operational turnaround finally in wind.
Yeah, which kind of leaves you with a big question, doesn't it? If electrification is growing this fast, and they're pouring money into things like transformers and those synchronous condensers. Just how fast does the global grid need to expand and modernize to actually handle all the new power generation GEV and others are building? What does that massive accelerating demand mean for how long it actually takes to get critical projects built, maybe even in your own backyard? Something to think about.